I guess that the Fitch rating, the revision has to be put clearly in context. They have not changed the rating for Nigeria. They had maintained all the previous ratings, and they had given, reasons, very positive reasons for why they did that. Nigeria's growth has remained satisfactory. Domestic and external debt ratios have remained low, and Nigeria remained a strong net external creditor position relative to the rest of the world, better than many of its rated peers. So let's not, approach this as if the outlook revision from stable to negative is bad news for the entire rating. Well, they have been influenced in expressing their pessimism about the outlook, by the, depletion of the excess crude account, by the steady decline in the external reserves. And I do not share their worries on those two. The reason Nigeria built up the excess crude account is to have something to spend, in bad times. And Fitch themselves had acknowledged that we just came out of a global crisis. What is a better time to draw down on your savings than during or immediately after a global crisis? So Nigeria did well in falling back on the excess crude account in the time of the crisis and shortly after the crisis. Now we're out of the crisis, oil prices are back up. You should expect the funds to accrue again into the excess crude account. On external reserves, I do not think the depletion of the reserves has been a Nigerian problem. It has been more of shocks, portfolio shocks arising from the debt crisis, say in the euro area, or the global rebalancing around the world. So you've seen pressure on the foreign exchange market that has made the central bank to deplete the reserves to defend the exchange rate because of problems elsewhere in the world, not because of problems here in Nigeria. So I do think that Fitch should have, given due cognizance to the increased, portfolio shocks hitting not just Nigeria, but any other country as the global economy tries to rebalance after a financial crisis.
Very strong views indeed coming from there. Now joining us on the line from London is Veronica Kalema, Director of Sovereign and International Public Finance at Fitch Ratings. Veronica, just in case you didn't hear those views coming from Nigeria, the view seems to be that you guys took essentially the wrong decision. There was no need to lower that outlook on that rating, and that essentially you're being a little bit short-sighted. What's your view on that?
No, it is. Put it this way, last year, when they drew down on this excess crude account, that was understandable. They did it's a stabilization fund, and that's what you do when oil prices drop, and last year oil production dropped. But this has continued this year when oil prices have risen and oil production has risen. And basically, reserves have also continued to fall. And that means that Nigeria has no buffers, leaving the economy very exposed to renewed fall in oil prices. To us, that's a big concern.
Now, in terms of lowering that outlook, of course, let's be clear here, you haven't cut the rating. You have just lowered the outlook on that rating. Now, in terms of the rating itself, after lowering the outlook, how big a danger is there that we could likely see a cut in the rating itself?
And the main things that would cause it to go right down to a B+ would be, a sustained fall in oil prices, if reserves continue to dwindle, and also heightened political risk. Those are the main likely causes of sources of a downward pressure on the rating.
Yeah. Now, some people would argue that heightened political risk shouldn't really come into play because we've got the advantage of incumbency here. Jonathan is running for re-election, and we've seen what his policies are like. And some people are suggesting that it's unlikely there will be any major change in economic policy come the new year, come the elections.
Well, but in the lead up to the elections, there's going to be political risk is going to be heightened. It's being heightened because of the decision to end the zoning agreement within the PDP. So you see that also has to play itself out. We don't really know how how much political risk will increase, but it's likely to increase. Yeah, I mean, so I don't think that you can say that there won't be increased political risk.
So
not until we
yes.
get past the PDP, and not until we get past the primaries.
Indeed. Now, so what does Nigeria have to do to get that rating outlook change again to perhaps stable or positive? In fact, a two-notch swing. I
mean, the government has realized, the problem with depleting the excess crude account and are remedying this situation through establishment of a sovereign wealth fund backed by legislation. And that, for example, if they could implement that, and we could see an increase in the funds in the sovereign wealth fund and see it fully operational, that would be a trigger. There would also need to, one of the reasons why the excess crude account has been depleted is it's not just withdrawals for the state and local governments. They've been taking the fuel subsidy out of the state excess crude account. So if they remove the fuel subsidy, that would also help in terms of rebuilding the stabilization fund and encouraging investment into the downstream petroleum sector.
Yeah.
I think those are the main things. On top, in addition to that, I mean, they've also unveiled a program to sort out the power problem, and it sounds really good on paper, but it would have to be implemented. Our view is that while this government reform momentum has picked up under this new government, none of these programs are likely to be implemented before elections.
Indeed.
So we're waiting to see the new government, the current economic team of the new government, what they'll do after elections.
Absolutely, Veronica. Thanks very much indeed for joining us. Kobe, this is a story that probably is going to be with us until the elections come and go. But just in terms of the action itself that the rating agency has taken, is it correct to look at the lead up to the elections and suggest that we are likely to see therefore heightened political tension and therefore a political, if you like, destabilization of the country's macroeconomic outlook?
Well, I mean, one has to just take into consideration what's happening over here. Okay, yeah. Nigeria, we've just seen some pre-election violence. We've just seen some bombs go off. Okay, we've also we've seen some things happening from a monetary perspective.
Yeah.
So when we take both those factors into consideration, Fitch is literally doing their job. I mean, a rating agency is literally like a canary in a mine shaft. Okay, they're doing their job.
They're trying to work after not working in the previous cycle.
Absolutely. So what they're trying to say, well, where is this thing going? Where do we think this thing's going? The more important question from an investment management perspective is what opportunity does this possess? What does this bring to effect?
Right.
Well, firstly, one has to say, is Nigeria going to continue to be a country, continue to be the second largest economy in Africa, and potentially going to be the largest economy in Africa? How, will this continue to be the case? And is there an investment opportunity I could potentially be taking? And is the Fitch downgrading potentially having a better opportunity to affect because of the downgrade? And those are investment management type issues. And those are kind of things that you do every day in the asset management industry. You're trying to look through the noise on a daily basis and trying to see the trend.
It would be interesting to look at the trades today and see if someone has been selling Nigerian debt, or there have been more buyers coming in and perhaps taking advantage of the opportunity that Kobe is referring to now.